Today, we're tackling one of the biggest hurdles for aspiring short-term rental investors, and that is financing your property.
Financing can be a hurdle if it's your second or third or even your 10th investment property. So no matter the size of your real estate portfolio, you may have some questions about financing it when you grow.
You might be wondering what financing options you might qualify for, how good your credit score needs to be, or what sort of down payment you're going to have to put down.
You might also be in a tricky situation where you don't have a W-2 job or you have a high debt-to-income ratio.
Those are all valid questions and concerns, and you are definitely not alone.
Financing can be one of the most intimidating parts of investing in real estate, especially if you're new to it or if typical financing methods maybe aren't the best fit for you.
But stress no more, because we're here to simplify the process for you. From conventional financing to more creative options, our goal is to break everything down for you today so that you can make an informed decision about which option is best for you.
By the end of this video, we hope you have a clear understanding of your financing options and to be one step closer towards purchasing your next investment property.
A quick disclaimer before we get started: everything that we're going to be sharing in today's video is based on our own personal experience, and it should not be taken as financial advice. So definitely do your own research as well. Let's get started.
The first method we're going to talk about is the most well-known, and that's conventional financing. This is what most people think about when they hear the word mortgage.
So what exactly is conventional financing? Simply put, it's a traditional mortgage loan that you get from a banker or a mortgage lender. And these loans typically come in two main types: a fixed rate and an adjustable rate mortgage.
A fixed rate mortgage has the same interest rate for the entire term of the loan, and the most common term that you see is 30 years, but you may also see 10, 15, or 20 years as well.
Fixed rate, 30 years. Boring, safe, small payoff, right?
So when you hear the term 30-year fixed, what they're referring to is a 30-year mortgage term with an interest rate that doesn't change, is fixed for the duration of that term.
The big pro here for a fixed rate mortgage is that your payment isn't going to change over time. In contrast, there's also adjustable rate mortgages, or ARMs as they're called, and that rate is going to fluctuate with changing financial market conditions.
This type of mortgage can be risky because as your interest rate changes, then your monthly payment will also change.
Let's talk a bit about the pros and cons of conventional financing. The main pro here is that with like a 30-year fixed loan, you're going to see a lower interest rate compared to other loan products such as DSCR loans, which we're going to talk about in a minute.
That being said, over the past 2 years, we have been able to creatively finance some purchases at a lower than market rate interest rate. So interest rates being lower for conventional financing, kind of a pseudo pro, depends on what you're comparing it to.
The biggest con for conventional loans is their strict qualification criteria. You're going to need a good credit score, stable income, and a solid financial history to qualify for that loan.
You're also probably going to need a larger down payment. Typically with conventional loans, you'll see 20% on an investment property, which depending on the price of the property can be a significant amount upfront, especially when you're also potentially adding in rehab costs and furnishing costs to get your property up and running.
This is getting really expensive.
In order to qualify for a conventional loan, lenders are going to look at three main things. The first is your credit score, then your income, and then your down payment amount. None of this is totally set in stone, and you might get different levels of scrutiny and things from different lenders, but this is just our advice from past experience.
Generally, lenders like to see a credit score of at least 620, but the higher your credit score, the better chances of your loan being approved and also at a better interest rate. That also means that if you watched our previous video on credit cards, please don't go out and apply for a new credit card right before you apply for a loan.
Or don't buy a new car. They'll be looking at your credit score. They'll probably pull your credit again right before or closely before you close the loan.
So wait until you're closed.
You bought a new truck?
The main thing with all this scrutiny is that lenders want to see that you have the income and don't have too many debts to feel confident that you can pay for this loan.
This usually means providing tax returns, pay stubs, and bank statements. And the lender will use all of that information to calculate your debt to income ratio. This is the ratio between the money that you have and make versus the debt that you already have and the additional debt that you'll be taking on with this purchase.
Debt to income ratio limits vary by lender, but you're going to see this range between like 35 35 and 45% most of the time.
And then they'll look at the down payment amount. So some loans will require as little as 3% down, but typically for an investment property, you're looking at 20%.
This down payment shows the lender that you have skin in the game and that you'll be less likely to default on the loan.
If you're looking to secure a conventional loan, you might have to start with improving your credit score.
You should do things like pay down your debts, make sure you're paying all your bills on time, and don't take on any new debt.
You'll also want to be saving for a down payment because the larger the down payment you can put down, the better the terms of your loan are going to be.
And you should shop around. Different lenders are going to offer different rates and different terms and different loan products, so it doesn't hurt to compare offerings from a few different lenders.
We've worked with different lenders for different types of purchases, and in some cases we've worked with no lender, like when we've done creative finance deals like seller financing and Sub2.
We'll link a couple of options below that we have worked with in the past.
So to wrap up conventional financing, this could be a good option for you if you have a strong financial history and can meet the qualification requirements.
But if this doesn't sound like the best fit for you, don't worry. We've got plenty of other options to talk about next.
Well, there are other options.
Next up, let's talk about DSCR loans, or debt service coverage ratio loans. The main difference between DSCR and a conventional loan is the income source.
Instead of scrutinizing your personal income to guarantee a loan, they're going to look at the income potential of this property as a rental to decide if that's enough to cover the cost of the loan.
The main pro with going with a DSCR loan is easier qualification. So if you don't have a traditional income source, or you have a high debt to income ratio because of owning and purchasing multiple properties, then this might be a good option for you.
Historically, DSCR loans were granted based on the long-term rental potential of a given property, but more and more recently, lenders are willing to look at the short-term rental potential, which often is quite high compared to long-term rental potential. So therefore, it's much easier to get one of these loans if you intend to use it as a short-term rental.
Most lenders are looking for a DSCR, which again stands for debt service coverage ratio, of between 1.2 to 1.5. And in case you don't already know, we'll explain what that means.
DSCR is calculated by taking a property's annual net operating income divided by its debt service costs. So if a property has a DSCR of 1.2, that means it makes 20% more income compared to its debt cost.
For example, if your property makes $100,000 per year in net operating income and your annual mortgage payments are $80,000, you take 100K divided by 80K equals 1.25. So this property is expected to produce 25% more than the debt.
Make it rain.
We've never personally used a DSCR loan before, but we have a few clients who have, and they've been able to scale very, very quickly, and they've purchased several properties in 1 year.
The biggest problem that we've seen with this DSCR quick growth strategy is over leveraging. So they're taking on a lot of debt at once, and then when the slow season hits, you have a lot of expenses to cover and maybe not the right amount of income coming in to cover that many properties.
So if you do decide to go the DSCR route, do it cautiously. Just because you can get a loan doesn't mean you always should. You should really spend a lot of time doing your own due diligence to scrutinize what you think you can make realistically versus what your debt payments are going to be.
Next up, let's talk about private money, which can be an interesting option if you're looking for quick access to funds on typically more flexible terms.
Private money is just what it sounds like. It's funds that come from either an individual or group of individuals or investors who will lend money at a given interest rate that's higher than normal interest rates and if it was just sitting in their bank account.
The pros of private money are that it's generally more flexible than when you're working with the bank. Typically, you can negotiate things like interest rates and a repayment schedule and other terms of the loan.
On the flip side, private money is definitely going to have a higher interest rate than a conventional loan and probably a shorter loan term. They range from maybe a 6-month loan to as short as just a few years.
So if you're financing a whole property purchase using private money, then you will probably need to think about an exit strategy when that loan comes due. For most people, this is going to be refinancing into a conventional loan at the end of the loan term.
Private money is a strategy we've used previously to purchase property, and in our case, we've used people that know us pretty well. They've had extra money that they wanted to lend, and it made the qualification really simple because they knew our business and they knew it was a pretty low risk to lend us money.
No, I learned never to borrow money from friends.
Next up on our list is seller financing, which can be a win-win situation for both buyers and sellers.
With seller financing, the seller of the property acts as the lender. Instead of getting a loan from a bank, you're going to make payments directly to that seller.
We've purchased one property using seller financing, and it was the easiest transaction that we've ever done.
The main pros are flexible terms, easier qualification, and a quicker closing time.
You can negotiate terms like the interest rate, the down payment amount, the repayment schedule, all directly with the seller until you've reached an agreement that works for both parties.
A seller might be more willing to work with someone who has a less than perfect credit score or doesn't have typical income, someone that's self-employed like we are.
People might think that that sounds very risky for the seller, but if we default on our loan payment, then he can foreclose on us just like a bank would.
Some cons of seller financing is that most sellers will require a balloon payment. And what this means is it's a large lump sum payment of the balance of the loan sometime sooner than the loan is amortized over. You might have a loan that's amortized over 30 years, but the seller wants a balloon payment at 10 years to be done with the whole seller financing game. This can be risky for you if you aren't prepared to pay that balance or if you don't have an exit strategy like refinancing into a conventional loan.
Also, not all sellers are willing to provide seller financing. Doesn't hurt to ask, but they might say no.
Seller financing is becoming more commonplace in recent years, but if you do ask, it might require a bit of educating between your real estate agent, if you're working with one, and the seller directly to make them understand that it could be a good deal for them.
In our seller financing deal, one of the big perks for the seller was that he owned the property outright. So if he were to sell to us conventionally, he would have been hit with a pretty high capital gains tax in that tax year.
But with seller financing, he's able to spread that gain over multiple years and keep more of his money.
We did a full video on our experience with that seller financing transaction, and we'll link that video at the end of this one so you can watch it next.
Finally, let's dive into a little more advanced creative financing method, and that's subject to deals.
In a sub-2 deal, you take over the mortgage payments on an existing loan. The loan remains in the seller's name, but you take over the property via a deed being recorded in your name, and then you are responsible for making those loan payments.
Subject to means you're buying the property subject to terms, and those terms are to repay the existing mortgage or maybe other details that you agree between the buyer and seller.
The pros of sub-2 are that you don't need to qualify for a new loan. So this can be a huge advantage if you have a low credit score or unconventional income sources. It also means that you get to keep the interest rate from when the loan was originated, which right now is probably going to be lower than today's current interest rates.
Sub-2 deals are also going to almost always have a lower down payment requirement.
We did our first sub-2 deal a few months ago, and our down payment was less than 10%. Then we had two agreements. The seller's existing mortgage was at 6%, and then a separate agreement for his equity portion at 0%. So the blended interest rates for those two agreements were very good.
Crazy. What a deal.
Yeah, this deal with the two agreements is called a hybrid deal, where you have one legal agreement to explain that you're paying the existing mortgage, and then another legal agreement to explain that you're paying the seller directly for equity, which is like a seller financing deal, that part of it.
Cons for sub-2 are that it can be risky if you don't take proper precautions. The due on sale clause is a valid concern for a lot of people who start looking into sub-2. So it's really important that you put all of those precautions in place with proper paperwork and agreements.
We go into the deal points and specifics about sub-2 deal in a previous video. We'll link in the description box below.
So we've covered 5 different ways that you can finance your next property purchase. We know that there are other methods out there, but we just wanted to cover the ones that we have direct experience with so that you can learn from our own experience.
Each one has its own advantages and challenges, so it's important for you to consider them all and pick the right one that matches your investment goals and your financial situation.
Let us know in the comments which method you might be considering for your next property purchase, and we'll link another video on screen we think you might want to check out next.
Thanks for watching. We'll see you in the next video.